1986. This was the big crash from 1987, remember? They called Black Monday. But more importantly, I would like to pay attention to this. So this is the year 1986, right? Here. Look at this, right? So this was until now the largest expansion in the US history. These were the Clinton years. In 1986, what happened in 1986, ladies and gentlemen? I think two important things happened. We'll have another slide for this, but what happened in 1986? Microsoft Corporation does IPO. Bill Gates IPO, and that to some extent 1990, that led to this whole technology computer driven rally, right? But more importantly, why is this important to pension funds? Because until then, the stock market was really not a big story, as you can see, right? It was always the Clinton years really when American equities took off, right here, this period here, right? And then of course we have the 2000 tech bubble collapse and a major collapse. And then basically here, 2003, all the way up to 2008. In 2008, the global financial crisis, boom, collapse, right? Citibank here was $52, here it was 98 cents, right? And since then, you have quantitative easing over the last 10 years, and this is now going into August, the largest expansion in history. Why is that important if you manage other people's money? Are we late stage cycle, early stage cycle? I mean, that's basically the debate. But just wanted to ask you something. The function of rates. Anybody remembers what were interest rates here in America at this point? How much was it? US dollar rates were 6% in around 2000, right? So that is Fed funds, right? Here from 6%, the market collapses. So you have 3 years of steady equity market declines. And here equity prices reach low. What was the interest rate here in America? Anybody remembers? The reason why I want to share this with you is because in your mind, try to overlay interest rates to equity prices. If you look at this, right? Equity here, interest rates were 1% in America, 1%. And then here, basically, market goes back up, and then the Fed is raising rates, right? And we ended here at 5.25%, and then, of course, the collapse. Rates went to 25 basis points. In Europe, they went negative. And since then, market has gone up almost like a straight line, and here now rates are rising again. So why is that important? Because is the market overvalued? Look at this first sentence here. What's everybody comfortable now may not be so comfortable later. And we potentially have an extraordinarily overvalued market, right? And what's important, the worst thing that there's a record overweight of equities. So again, US pension funds as part of their portfolio composition have a large amount of stocks that they ever had before, right? So now the allocation to equities is extremely high when potentially we're late stage cycle, right? So think about this. Nobody has owned this many equities or equity-like instruments, risk-seeking instruments, ever before when valuation is so high. This is a dangerous setup. And just think about this, right? By the way, have you noticed something? What's the time from here to here? So this is 2000, right? This is 2008. This is what, 8 years, correct? 2000 to 2008 is 8 years. From 2009 onwards to 2018, how many years is that? Huh? So again, what that shows you is that that expansion we have seen is rather late stage. And I agree with this gentleman from Barclays, Absa, right? Michael, right? That maybe now is the time to buy gold because equities potentially is rather late. But fully equities enough in alternative investments. So why is the demographic time bomb, right? Also, if you overlay this, right? Let me think about this again here. Many people are starting to retire now here, right? So that the baby boom and more old people go. We'll talk about this in a minute, right? But because you got nothing on cash, right? America had zero interest rates for a long time, and then in Europe, negative interest rates, right? So investors, pensioners were ever pushed out more on the risk curve just to get any returns. That potentially now is at a level where, right, where basically the system could change. So here, as you can see, the mathematics don't necessarily up. The entitlements can explode, right? And these could be in the hundreds of trillions of dollars, right? Yeah. So you have more and more young people trying to pay into the system, and there might not be enough money to actually go around for this, right? So this is what often I think we could call the pension crisis, right? Think about this for a minute. Many people are taking more risk than they understand, right? For example, US equity inflows were the highest last year on record, right? When the market already was on record time, right? So I would like you to think about this again, ladies and gentlemen. Can you read this sentence? One bet people are taking is they're actually putting their maximum allocation of all recorded history across the entire system into risk-seeking equity-like assets when equity valuations are off the charts. Think about that for a minute. All right, so again here, what I mean by off the charts is this, right? And now most pensions have most of their money in equities or equity-linked investments, right? So think about this. It's actually a little bit complicated, but it's this relationship between Wall Street and the pension industry, right? For example, what is highlighted here, this trend has gone on for a long time. What is highlighted here in red is the following. The trend of consumption within the US economy continues to this day. It's massively outside because of the credit boom. That meant that Wall Street became outsized too. It was taking the money from the pension system and investing that or speculating with it and making money from the credit side. Now we're in ended the blow up that happened in 2008. So again, it is that relationship with the pension industry then taking the money to the market. But when more and more people retire, a lot of these inflows potentially are at least becoming less, or potentially are even coming negative. That potentially means that sort of equities have a headwind. So here, this is the key point, please. Have a look at this. And what it meant is the following. Many people have borrowed too much money. The American economy is a debt-driven economy. Remember we spoke about Bitcoin? Bitcoin is asset-based, right? So it's not based on debt. But the debt bubble has actually, to some extent, basically expanded the equity market rally. Think about it this way. In America, share buybacks are very popular. So companies, what they're doing, they borrow money to buy back their own shares. Share price goes up, but the managers, the CEOs of these companies often get paid in bonuses depending on the share price. So that has led to further equity prices rising, but it has not really benefited the average worker nor the average person. And this is the risk that I see going forward, that basically capital market assumptions, right? So return assumptions most probably have to be reduced, right? Some people are even saying that over the next few years, you can potentially have lower returns, if not negative returns. If that is the case, many pension funds in the Western world would not be able to potentially deal with that, right? And if you think about this for a minute, right, look at this again, right? You have basically now going forward negative returns, right? By the way, since here, what happened? Remember, by the way, when was Bitcoin founded? Remember, we spoke about this, right? 2008, 2009, correct? That's when the Bitcoin blockchain came into being, right? What is the point on the chart? Here, right? This is when basically 2008, 2009 Bitcoin was created. But this is predominantly a debt-driven, debt at the higher level of sort of quantitative easing. Quantitative easing is often a very complicated, fancy word for the central bank working with the banking system and buying assets from the system to inject cash, right? driving up. The question is, are equities cheap? I know some of you have studied these things and have done exams and can calculate price earnings ratios and all this sort of thing. But the more important question is, and some people say, but equities are cheap because bonds are even more mispriced. Because central banks have been, central banks in the old days were what is often known as the lender of last resort. When there was a crisis, they stepped in. Now what they have become is they're becoming the buyer of the first instance. For example, Japan, right? Japan has now almost nationalized the stock market. I think the exact numbers escape me, but the Bank of Japan is one of the largest buyer of Japanese ETFs. So they have almost nationalized the stock market with